Good morning, friends. So today we'll start question number 21. Please come to question number 21. Following are the estimates of the net cash flow and probability of a new project of Messrs. X Limited. Year is given, probability is given, year 0, 1 to 5, year 5. Initial investment is given. Estimated net cash flow after tax inflows are given. Estimated salvage value after tax is given. The required rate of return of the project is 10%. Find out. So these are the questions. Expected NPV of the project, best case NPV, worst case NPV, the probability of the occurrence of the worst case if the cash flows are perfectly dependent over time and independent over time. Then standard deviation and coefficient of variation, assuming that there are only three streams of cash flows which are represented by each column of the table with the given probabilities. Last question is coefficient of variation of X Limited on its average project, which is in the range of 0.95 to, this end range is not given, maybe you can write 1.20. If the coefficient of variation of the project is found to be less risky than the average, 100 basis points are deducted from the company's cost of capital. The meaning of this line is that if your coefficient of variation is found to be below this range, then the cost of capital, which is 10% here, will be reduced by 1%. So then it will become 9%. Should the project be accepted by X Limited? So these are the questions here. How do you solve this question? First question is expected NPV of the project. First question is expected NPV of the project. So how do I compute the expected NPV of the project? Can somebody help me please? Expected NPV of the project. We have three possibilities. Either this combination can realize, or this combination can realize, or this combination can realize. Is it right? So I am going to first compute three NPVs, assuming that initial investment will be 4 lakh, estimated cash flow after tax will be 1 lakh, and salvage value. And the same thing we will do here also. We will compute 3 times NPV, and once we compute 3 times NPV, we can multiply by the respective probabilities. We can multiply by the respective probabilities and we'll be able to find out the expected NPV. Then the second question is very easy. Best NPV, worst NPV. So we have 3 NPVs with us. The lowest one is the worst and the highest NPV is the best case. And then probability of occurrence of worst case. If cash flows are perfectly dependent over time and perfectly independent over time, so that I will explain later. First let us complete part 1 and part 2, which are very easy. This question was asked in May 2010 exam for 12 marks. Can you believe that? So one by one we'll solve and then I will explain further. So please come to step number 1. Calculation of NPV. Calculation of NPV. calculation of NPV. Under that, draw this table first. First column year, second column particulars, third column discounting factor at the rate 10%, discounting factor at the rate 10%, then probability column, under probability column, probability equal to 0.3, two columns, cash flow column and discounted cash flow column, and discounted cash flow column, then probability equal to 0.5, cash flow, discounted cash flow. Discounted cash flow means PV of cash inflow, and probability equal to 0.2, cash flow, discounted cash flow. So we will get three answers. We will get three answers. First you write down column number 1, 2, 3, 4. Column number 5 is 3 into 4. Column number 6, 7 is 3 into 6. Column number 8, 9 will be 3 into 8. Column number 3 is discounting factor, which is common. So I am solving one of the very important questions of this chapter. Okay, and they can repeat in the exam also for 10 to 12 marks. So please take a calculator, pen, pencil and write. Year 0, initial investment. Year 0 initial investment. In first case it will be 4 lakh. Present value will be 4 lakh. Second case also 4 lakh. Initial investment is same, 4 lakh rupees each. 4 lakh rupees each. 1-5 annual cash flow. Present value is 3.791. If first situation arises, annual cash flow will be 1 lakh. So what you do? Multiply 1 lakh into 3.791. 3,79,100. Next, in second scenario, it is 1,10,000. 1,10,000 into 3.791. 4,17,010. 4,17,010. Third scenario, 1,20,000. 1,20,000. The answer is probability will be 4,54,920. The DCF will be 454,920. And fifth year, write down salvage value. Fifth year discounting factor 0.621. 0.621. Fifth year factor is 0.621. Probability 3.3 cash flow 20,000. In this scenario, salvage value is 20,000. Multiply please and give me the answer 12,420. In scenario 2, when probability is 0.5, cash flow will be 50,000 salvage value, and multiply please. Multiply with this factor 31,050. Third scenario, you will get salvage value 60,000. Multiply by the discounting factor 37,260. 37,260. 37,260. 37,260. Now please tell me the total of this column. Everybody please try. Total of DCF column. Total of DCF column. Please give me the answer. 8480. Is 8480 right? Next answer please. 48060. 48060. Next answer 48060. And the last answer please. 92180. 92180. These are the three NPV possible depending upon scenario 1, scenario 2 or scenario 3, whose probability is 0.3, 0.5 and 0.2. Now if they ask you what is expected NPV of the project, this NPV multiply by 0.3 probability, this NPV 0.5 probability, this NPV 0.2 probability. So write down the answer below. Step 2, you have to write nicely. Write nicely. One day you have to write in the exam also same question. Then how do you present it? Calculation of expected NPV, 3 columns. 3 columns. One column write NPV, second column probability, third column expected NPV. Third column expected NPV. Under that write NPV column number 1, probability column number 2, expected NPV 3 is equal to 1 into 2. These are my 3 NPVs. These are my 3 NPVs and these are their probabilities. Please multiply and give me the total. Multiply and give me the total. Multiply and give me the total. What is the answer now? Total please, total, come on. What is the total of the last column? Total of the last column is 39922. 39922. This is my first answer, expected NPV. Now write down step 3. Step 3. In step 3 the question says what is the best case NPV and what is the worst case NPV. So the smallest NPV is worst one and the highest NPV is the best one. So if your luck is bad, then you will get this combination, the first combination, and your NPV can be negative 8480. And if your luck is good, best case NPV you will get, and your NPV can be 92 180. Is it right? Your NPV can be 92 180. This is my second answer. First and second answer were very easy. Third answer, the probability of occurrence of worst case. What is the probability that you will get negative NPV of 8480 if cash flows are perfectly dependent over time and perfectly independent over time? You have to answer. If cash flows are perfectly dependent over time, dependent over time means if cash flow is low in 1 year, it will be low in each year. And if this is the meaning of dependent, if cash flows are low in 1 year, then in all other year it is bound to be low. And independent means each year cash flow is independent. Each year cash flow is independent of previous year. Independent of previous year. Now my question is, if cash flows are independent in each year, so if the probability of getting 8480 negative is 0.3, every year cash flow is independent of the previous year, so I'll get 0.83 into 0.83 into 0.3 into 0.3. But if cash flows are dependent, means if I get 0.3 in 1 year, first year, I am going to get 0.3 in all the years. Then my subsequent year will be only the lowest combination. So therefore, in the first case, when the cash flows are dependent, the moment you find that you have got low cash flow in the first year, it is bound to be low in all the other year. So probability of getting low cash flow in the first year is 0.3. That will be my dependent answer. And for independent, each year is independent. Each year is independent. So if each year is independent, I will have to apply joint probability concept. I have to apply joint probability, because what is the possibility of getting low in first year and low in second year and low in third year and low in fourth year and low in the fifth year? That is the meaning of finding the probability when cash flows are independent over time. So I am going to write this answer nicely for you. Write down step number 4, probability of worst case NPV. Probability of worst case NPV. Probability of worst case NPV. Probability of worst case NPV means, what is the probability you will get negative 8580. Write down nature, perfectly dependent over time. Perfectly dependent over time. If it is perfectly dependent over time, means if you know first year will be worst, it will be worst in all the remaining 4 years. So whatever is the probability of getting worst NPV in first year becomes the probability for the entire project. Okay, so it will be 0.3. It will be 0.3, even though reasoning was not asked in the question. I will give you the reasoning in the writing also. If you look at the institute answer printed below, there is no explanation. They have only written 0.3. But write down the explanation also. Write down the explanation also. If the cash flows are perfectly dependent, if cash flows are perfectly dependent, then low cash flow in the first year, will mean a low cash flow in every year. Therefore, probability of worst case NPV, is the probability of getting rupees 20,000 cash flow in year 1, is the probability of getting rupees 1 lakh cash flow, make it 1 lakh, rupees 1 lakh cash flow in year 1, is the probability of getting rupees 1 lakh cash flow in year 1. So if you get 1 lakh in first year, you are going to get 1 lakh in all the years, and therefore just search for this probability, which is 0.3. If cash flows are dependent over time, if you get low cash flow in 1 year, you will get low cash flow in all the remaining years. Now write down please, independent over time. Independent over time means second year cash flow is independent of first year cash flow. For example, in first year, if I get 0.3, Then second year I have three possibilities. I can get 0.3, 0.5, 0.2. If I get 0.3 in the second year, then again in the third year I have three possibilities. If I get 0.3 in the third year, I will have three possibilities in the fourth year, and same thing here also. So 0.3 into 0.3 into 0.3 into 0.3 into 0.3. That is what is the probability you will get 1 lakh, 1 lakh, 1 lakh, 1 lakh in all the 5 years, and these are independent. So I have to apply joint probability, and I need to multiply 0.3 into 0.3 5 times. So write down the answer please. Write down the answer please. And this is the explanation. We have given the diagram to explain 0.3, 0.3, 0.3, 0.3, 0.3. But other possibilities also exist. So this is, you have to multiply. What is the probability of getting 1 lakh in year 1 and 1 lakh in year 2 and 1 lakh in year 3, which means you have to apply joint probability. Write down 0.00243, 0.00243. Write down the explanation. Explanation is not required for the exam. Explanation is not required for the exam, but you have to write the explanation so that in future when you are revising it, you can understand. Right. Each year revenue stream carries an independent probability. If cash flows are independent, the cash flow in each year can be low, high or average. The probability of getting all low cash flows will be cumulative probability of worst scenarios. That is why we have to multiply by all the probabilities, because cash flows are independent over time. So that was the answer of question number Roman 3 of this question. Do you have any query till now? Yes, please. Do you have any query? Okay. If you have no query, come to the fourth question. Compute standard deviation and coefficient of variation, assuming that there are only three streams of cash flow which are represented by each column of the table with the given probabilities. So write down calculation of standard deviation. You are given a probability distribution table. You have to find standard deviation. Three columns we will draw. First column NPV, second column probability, third column x minus x bar square into probability. X minus x bar square into probability is equal to x minus, the x bar means expected NPV. What is x bar here? X bar, this is expected NPV, already calculated, square into probability. Okay, and there are three possible NPVs. Please write, there are three possible NPVs: 8480, 48060, 92180, with following probabilities: with falling probabilities: 0.3, 0.5, 0.2. Now what you do on your calculator, first you type minus 8480 minus 39922 into equal to into 0.3. So you will get the answer like this, something very big number, 70 crore 28 lakh 26,081.20. Try the next one. Type on your calculator 48,060 minus 39,922 into equal to into 0.5 equal to 3 crore 90 lakh 55,122. Try the next one. You can transfer it to memory plus first, so that you don't have to take total separately. 92,180 minus 39,922 into equal to into 0.2. So that is equal to 54 crore 61 lakh 79,712.8 memory plus. If you have transferred all the three numbers to memory plus, memory recall, this is the total. Oh my God, 128 crore 80 lakh 60,916. Do not round off, your square root can be different. Do not round off, otherwise the square root you have to take for standard deviation, the answer can change. Is it right? So please write down below standard deviation equal to under root 128 crore 80 lakh 60,916. Anybody wants to reply? What is the standard deviation? Please reply. What is the standard deviation? Please reply. So that is approximately 35,890. That is approximately 35,890. Standard deviation. Now write down coefficient of variation. Coefficient of variation will be equal to, what is the formula for coefficient of variation? Yes, Divya. What is the formula for coefficient of variation? Coefficient of variation is standard deviation upon expected NPV. Standard deviation upon expected NPV. What is the answer now? Standard deviation is 35890. Standard deviation is 35890 and expected NPV is 39922. So what is the answer, please? Answer, please. Is the answer 0.90? Is the answer 0.90? Okay. This is my second answer. Coefficient of variation. Third answer. Coefficient of variation of X Limited on its average project, which is in the range of 0.95 to 1.20, you can write to 1.20. If the coefficient of variation is found to be less than the average, 100 basis points are deducted from the company's cost of capital. So our coefficient of variation is less than the average. So cost of capital will reduce. Write down risk adjusted cost of capital. Risk adjustment out of cost of capital of X Limited. Risk adjusted out of cost of capital of X Limited. Write a note first. as coefficient of variation is less than 0.95, as coefficient of variation is less than 0.95, cost of capital will reduce by 100 basis point. Cost of capital will reduce by 100 basis point, that is 1%. That is 1%. Hence RADR means risk adjusted discount rate. Hence RADR is equal to 10 minus 1, 9%. Now write down calculation of NPV. Calculation of NPV with 9% discount rate. Calculation of NPV with 9% discount rate. Draw a table with 4 columns. Year, expected net cash flow, PV at 9% and PV. Year 0. Year 0, 4 lakh rupees. Present value 4 lakh. Year 1 to 5, what will be my expected net cash flow? There are 3 possible cash flow. 1 lakh with 0.3 probability plus 1 lakh 10,000 into 0.5 probability plus 1 lakh 20,000 into 0.2 probability. So calculate and give me expected net cash flow. Expected net cash flow is 1 lakh 9,000. Expected net cash flow is 1 lakh 9,000. PV factor at 9%. Come on, PV factor at 9%. PV factor at 9%, 3.890. Please check. 424,010 present value. 424,010. Then 5, year 5, expected salvage value. Expected salvage value can be 20,000 with 0.3 probability plus 50,000 with 0.5 probability, 60,000 into 0.2 probability, and that is equal to 43,000. Write the factor. .650 multiply please. 43,000 into 0.650, 27950. Take the total. The total comes to 51,960. Check the total and confirm. Only say yes, it is right. 51,960. Check the total and confirm whether your expected NPV is 51,960. Is it 51,960? Write a note whether project should be accepted or not. That was the question. That was the question. So write advice. Advice, write down project should be accepted. Advice, write down project should be accepted. Project should be accepted because NPV is positive. Project should be accepted because NPV is positive. Okay. That was a very important question. Number 21. Did you like it? Those who liked it will say yes. Now we'll come to question number 22. XY Limited has under its consideration a project with an initial investment of rupees 1 lakh Three probable cash flow scenarios with their probability of occurrence are estimated below. So you can get annual cash flow of 20,000 or 30,000 or 40,000 with probability 0.1, 0.7, 0.2. Project life is 5 years and estimated desired rate of return is 20% this time. The estimated terminal value for the project asset under the three probability alternative respectively are 0, 20,000 and 30,000. So this is like previous question only. These are the three possibilities. This is annual cash inflows. These are respective salvage value. Find out the probable NPV. Same problem. Find out the worst case NPV and best case NPV and state the probability of occurrence of worst case if cash flows are perfectly positively correlated over time, and second, independent over time. Right? Calculate standard deviation and coefficient of variation. So we'll do this practice one more time. Actually it could be given as homework also, but don't worry, I will try it one more time for your practice, because I think this question is important. So write down, Mr. Rakesh Bhatia, you also write down. Calculation of NPV. Calculation of NPV. Same format we'll draw again. Year, particulars, discounting factor at 20%. Then we have three possibilities. Probability equal to 0.1, cash flow, discounted cash flow. Probability equal to 0.7, cash flow, discounted cash flow. Probability equal to 0.3, cash flow, discounted cash flow. Column number 1, 2, 3, 4, 5. 5 is 3 into 4. Column number 6. 7 equal to 3 into 6. 8. Column number 9 is equal to 3 into 8. 9 is equal to 3 into 8. Write down year 0. Year 0 initial investment. Year 0 initial investment. In this question it is 1 lakh. Write down 1 lakh, that will not change. 1 lakh is constant. Then write down annual cash flow. Annual cash flow would be, first you compute the annuity factor. 5 year 20% annuity factor. 2.9906. 2.9906. Cash flow would be 20,000, multiply 59812. Cash flow can be 30,000, multiply with annuity factor 89718. 89718. Probability 0.2, cash flow 40,000 into 2.9906. 1,19,624. Salvage value will be received in year 5, fifth year factor at 20%, fifth year factor with 20%, 0.4019, 0.4019. Present value will be 0 in the first scenario, then 20,000 in second scenario with 0.4019 factor, 8038. Very good. Next, 30,000. 30,000 into 0.4019, 12057. 12057. NPV. NPV. can you tell me NPV in first case? NPV in the first case, anybody please reply, come on, reply fast. 40188. Next one, come on. 8038. Negative 2244. Negative 2244. Is it right? Last one, come on, last one. Come on, last one. Answer last one. 31681. 31681 positive. These are my three NPVs. The benefit of this table is that you will be able to answer best case NPV and you will be able to answer worst case NPV also. You will be able to answer best case and worst case NPV also. You will be able to answer best case and worst case NPV also. So that is why I have decided this format. Okay, write down below. Step 2, calculation of expected NPV. Calculation of expected NPV. Calculation of expected NPV. Draw this table with 3 columns. Draw this table with 3 columns. NPV, probability, expected NPV. Column number 1, 2, 3. Third column is 1 into 2. Third column is 1 into 2. Then these are the 3 NPVs computed above. Copy NPV from previous table 40,188, 2244 negative, 31,681. Up to this you have written. Then probability would be 0.1, 0.7, 0.2. Multiply memory plus function also you will use. 40188 into 0.1, 4018.8 memory plus 2244 into 0.7 equal to memory plus 1570.8. 31681 into 0.2 equal to memory plus 6336.2. Memory recall, you will get the total. Memory recall expected NPV is 746.6. 746.6. 746.6. Write down step number 3. Step number 3. The question is, what is the worst NPV and what is best NPV? Write down worst case NPV equal to minus 40188. Minus 40188. Best case NPV equal to, which is the highest one, 31681. Best case NPV can be 31681. So you can get in the worst scenario this NPV, in the best scenario you can get this NPV. Okay, the lowest one is the worst case NPV out of the 3 and the highest one is best case, but there is a probability also. So that is why they have asked you the next question. Calculate the probability of occurrence of worst case NPV. This NPV, if cash flows are perfectly positively correlated over time or cash flows are independent over time. So if cash flows are perfectly correlated over time, which means if you get lowest cash flow 20,000 in year 1, you will get 20,000 in all the year all the years, you'll get 20,000 negative in all the years. You'll get 20,000 negative in all the 3 years. Okay. So if I have to draw the diagram for you for the correlated, perfectly correlated, in year 1 we have 3 possibilities: 20,000, 30,000 and 40,000. Come on. But if you get 20,000 in year 1, then you will get 20,000 only in year 2, 20,000 in year 3, 20 in year 4, 20 in year 5. Then only 20, 20, 20, 20 will continue. Only 20. So whatever is the probability of this 20,000, because the probability of future 20,000 becomes 1. You will not get any other cash flow except 20,000 in the second, third and fourth, fifth year. So write down probability of worst case NPV. 3 columns we will draw. First column nature, second column probability, third column reasoning. Third column reasoning. Nature write down perfectly dependent over time. Perfectly dependent over time. Under that write down probability is 0.1. Probability is 0.1. Because if they are perfectly correlated over time, then whatever cash flow you'll get in the first year, you'll get the same cash flow in the remaining years. Reason write down. Reason write down. If cash flows are perfectly dependent, if cash flows are perfectly dependent, if cash flows are perfectly dependent, then low cash flow in the first year, low cash flow in the first year, low cash flow in the first year will mean a low cash inflow in every year. Will mean a low cash flow in every year. Will mean low cash flow in every year. Will mean low cash flow in every year. Therefore, probability of getting worst NPV, probability of getting worst NPV is getting worst NPV is getting is the probability of getting 20,000 cash flow in year 1. Is the probability of getting 20,000 cash flow in year 1. Okay. Now write down independent over time. Independent over time. Independent over time. Under that write, you have to multiply by all the 5-year probability. 0.1 into 0.1 into 0.1 into 0.1 into 0.1. Because what will happen in second year is independent of what will happen in the first year. So it is like this. It is like this. In year 1, we can get 0.1. Then in year 2, we can get 0.1. We can get other also. In year 3, we can get 0.1. In year 4, we can get 0.1. And year 5, we can get 0.1. So what is the probability of getting 0.1, 0.1, 0.1, 0.1 in all the years? In that case, we have to apply joint probability. Which stream carries an independent probability? If cash flows are independent, if cash flows are independent, the cash flow in each year can be low, high, or average. Cash flow in each year can be low, high, or average. The probability of getting all low cash flows will be cumulative probability of worst scenarios. Is it right? Is this right? Anybody please reply, is this right? And now the next question is, calculation of standard deviation and coefficient of variation. Please write down 16 crore 75 lakh 64,148. Next one, memory plus, transfer it to memory plus. Next one, minus 2244 minus 746.6 into equal to 0.7 equal to memory plus 62 lakh 60,582. Next one, 31,682 minus 746.6 into equal to 0.2. Huge number, memory plus 19 crore 13 lakh 87,421. Memory plus, then memory recall. Total is 36 crore 52 lakh 12,150. Standard deviation under root this number and check the answer. If it is right, please confirm. Check if it is right. 19110.52. Is it right? 19110.52. Is it right? Okay. Now write down coefficient of variation. Coefficient of variation write down is equal to standard deviation upon expected NPV. Standard deviation upon expected NPV standard deviation upon expected NPV, write down 19110.52 divided by 746.6. So the answer is 25.59. The answer is 25.59. The answer is 25.59. Is it right? 25.59. Is the answer right? 25.59. The answer for this question was 25.59. So this answer is over. One homework, write down same question. 2 times I have solved it for you. So now you can do homework. Question number 23. Question 23 homework. Okay. Keep 2 pages blank. For homework, 2 pages blank. 2 pages you will keep blank. Yes. Divya, do you have any query? Question number 23 is homework, same question. Now please come to question number 24. Please come to question number 24. Again write down very important. Very important question number 24. Question is from study material. Question was asked in November 2009 exam also for 10 marks. Is it right? Question number 24. New Projects Limited is evaluating 3 projects. New Project Limited is evaluating 3 projects. P1, P2, P3. Following information is available in respect of these projects. So there are 3 projects. Cost is given. Inflow in year 1, 2, 3, 4 is given. For project 1, inflow is same, 6 lakh rupees. For project 2, project 3 inflows are changing. And risk index is given beta. Beta is different. Why beta is given? Why beta is given? Yes, please reply. Why beta is given? Beta is given so that you can compute risk adjusted discount rate. Okay. Minimum required rate of return of the firm is 15%. Risk free rate is 10%. Risk free rate is 10%. Find out the risk adjusted discount rate for these projects and which project is the best. So we will use beta, risk free rate, and this is like market required rate of return. This 15% we will treat it as like market return, and therefore using these 3 we can find out the RADR by applying the principle of CAPM. Restart. By applying the principle of RADR. Is it right? And then after that we'll compute NPV. After computing NPV, we will answer which project is best based on highest NPV. Based on highest NPV, we will decide which project is best. Is it right? So are you ready for this question? Are you ready? Write down step 1. Step 1. Calculation of risk adjusted discount rate. Calculation of RADR. Under that write down. Under that write RADR can be found by RADR can be found out by RADR can be found out by using the principle of CAPM, using the principle of CAPM as follows. Using the principle of CAPM as follows. So I need to find out required return as per CAPM. First column write risk-free rate. Second column write required return. Third column write risk index. Third column risk index. Fourth column RADR. RADR will be equal to RF plus risk index into K minus F. K minus RF. Okay, so let us solve. First one, risk-free rate 10%, required return 15%. Let us call it K. Let us call it K. Risk index 1.8. Please solve. 10 into 1.8. 10 into 1.8 into 15 minus 10. Higher the risk, higher the required return. Higher the risk, higher the required return. That is the topic called risk adjusted discount rate. Next one you will try. Come on student, try next one. I'll wait for your answer. In second case, please tell me what is RADR. Second case, what is RADR? What is RADR? Second case. Is it 15%? Is it 15%? Is it 15%? Now try the next one. Try the next one. Very good. Try the next one. Third one. Try the third one. Third one answer is yes, Bhatia is right. Divya is right. Third one, 13%. Third answer is 13%. Very good. Can we go to our main answer? I have to find NPV of the three projects. I have to find NPV of the three projects. And I am going to use different discount rate for the three projects. I am going to use different discount rate for the three projects. For first project we'll use 19%, for second project 15%, for third project 13% because the risk is lowest. Okay, so dear student, please write year 0 and first heading write down NPV of project 1. You are writing in notebook? Are you writing in notebook? Year 0 for project 1 investment is 15 lakh, annual cash flow 6 lakh. Calculate the NPV for yourself. Calculate NPV yourself. Calculate NPV on your own. Calculate NPV on your own. What is the answer? 15 lakh. 1583 400 total NPV 83 400 NPV 83 400. Step 3, NPV of project 2 NPV of project 2 NPV of project 2. Again we'll draw the table. Very good, Divya. NPV of project 2, year, particular, cash flow, discounting factor at 15%, discounted cash flow, year 0, investment required 11 lakh, year 1, annual cash flow 6 lakh, 2, 4 lakh, 3, 5 lakh, 4, 2 lakh. Use factor now 15%. 1 divided by 1.15 equal to 0.870 equal to again 0.756 equal to 0.658, 0.572. Now please multiply and give me the total. Please multiply and give me the total. Come on. Multiply cash flow and discounting factor and total. Yes, you have to answer. Then only we can proceed further. Anybody who got the answer? NPV of project 2. NPV of project 2. NPV comes to 1,67,800. 1,67,800. Very good. Approximately you are right. Because I have used 3 digits, you can use 4 digits, 5 digits. You can do directly also. So this will change slightly. Don't worry. 1,67,800 or around 1,70,000 something is okay. Otherwise, check the answer yourself once again. If the difference is very high, please check the answer yourself again. We'll go to now step number 4, NPV of project 3. Draw the same table. This time discounting factor will be 13%. Please solve. Please solve. Everybody please try. Try to solve 13% factor. Year 01, 1 divided by 1.13, 0.885. Press equal to. Write the factors. Write the factors. You can do directly in the last column also. Okay, no problem. Answer must be correct. Come on, student. Check the answer now. Check the answer now. Anybody total? Waiting for your answer. Waiting for your answer. Please tell me the total of last column. Total of the last column. So this is approximately 2,13,860. Approximately 2,13,860. Now compare the three NPVs and select that NPV which is highest. Which NPV is highest? Which NPV is highest? Project 3 NPV is highest. Conclusion write down. Conclusion write down. Project 3 has highest NPV. Project 3 has highest NPV. So it should be accepted by the firm. So it should be accepted by the firm. So it should be accepted by the firm. Higher NPV maximizes the wealth of shareholders. Higher NPV maximizes the wealth of the shareholders. That was my question number 24 for you. Question number 25, homework. Question number 25, homework. A very easy question. A very easy question, you can do it. Question number 25, homework. I have given you the answer in the booklet. Do it. If you have a doubt, you will ask me. Question number 25 goes for homework. Now we'll solve question number 26. Question number 26 now. X Limited presently operates in a cement industry with a debt equity ratio of 2:1. Very different problem. This question you will not find in the institute publication, but you have to know it. So question number 26, write down, very different question, very important question. X Limited presently operates in a cement industry with a debt equity ratio of 2:1. It consists of debt and equity. Cost of debt and equity are 13 and 17% respectively. It is subject to 30% tax rate. It feels that growth rate in cement company is going to be low or moderate. It therefore decides to strategically diversify into new emerging biotechnology sector. Very good. The project cash flow from the long-term fund point of view are shown below. Year 0 outflow, year 1, 2, 3, 4 cash inflow. The amount of rupees 170 crore will be financed by debt equity ratio in the ratio of 3:1. Debt would be by way of a 4-year term loan from ICICI Bank at an interest rate of 16% per annum. To understand the risk of equity in biotech business, that means to find cost of equity, two proxy firms, Bharat Biotech and Granular Biotech Limited, have been identified. The details are given below. Name of the company, debt equity ratio, tax rate, and their equity beta. Bharat Biotech Limited, debt equity ratio 2.5, tax rate 35, equity beta 2.2, Granular 432, 1.9. So these two firms are representative of the industry. These two firms are representative of the industry. Based on similarity of the asset, it is considered to assign 70% weight to B. B means Bharat Biotech, and 30% weight to G. G means Granular Biotech Limited. Then RF is 8%. RF means risk-free rate. Make it RF. Risk-free rate. Risk-free rate. This is, make it RF. Is 8%. Market risk premium means RM minus RF. RM minus RF is 7%. Find out the NPV of this biotech business. So what I need to do, I need to find WACC. For that I need cost of debt, cost of equity. But to calculate the cost of equity, I need to find out KO of the industry. I need to find out the KO of the industry, or to need overall beta, you can say, because this will depend on RF plus beta of equity into RM minus RF. But to get beta of equity of this company for this business, I will require overall beta of the industry. There are two representative firms. Using their equity beta, tax rate, debt equity ratio, I will find out beta of overall beta based on these two firms. After getting that, we'll multiply by the weights given in the problem. So that will give me overall beta of the industry. Using overall beta of the industry, we will find equity beta. After finding equity beta, cost of equity, cost of debt, WACC, and the WACC will be applied to find out the NPV of biotech business which this company is starting. This question is a mixture of two chapters. This question is a mixture of advanced capital budgeting plus portfolio. Okay, from portfolio management chapter, we will learn how to find unlevered beta, and I will use unlevered beta to find levered beta, and then we can compute cost of equity and overall cost of capital. Very, very important question. If suddenly it is asked in the exam, you should not be caught surprised. Okay, so I request you to concentrate and write the answer in detail in the notebook. So first I need to use the logic of overall beta learned from portfolio chapter. Write down please. Step 1. Calculation of overall beta or unlevered beta. Calculation of overall beta or unlevered beta. Under that, 3 columns. Company, calculation, overall beta. Company, calculation and overall beta. Company, right. Bharat Biotech, calculation, right, formula. Overall beta formula is beta levered beta upon 1 plus debt by equity into 1 minus tax rate. Do you remember this formula? Do you remember this formula? Say yes or no. Right below. Right below 2.2, that is your equity beta in the last column, divide by 1 plus debt equity ratio is 2.5 into 1 minus tax rate 0.35. Can you please solve? Please solve this part and answer. Solve this part and answer. Is it 0.84? Yes, please confirm. Is it 0.84? Is it 0.84? Bhatia, is it 0.84? Okay. Now write granular biotech. Here the data is 1.9 upon 1 plus debt equity ratio is 4 into 1 minus 0.32. Very important question you are solving. You will not find in institute publication, but they will ask you. That time don't get surprised. Practice now. More practice now is more useful for exam. Is the answer 0.51? Is the answer 0.51? So these are the overall beta based on these two companies. As per the question, will give a weightage of 0.70 and 0.32, these two number, so that we'll get weighted over a average overall beta. Please write down. Please write down weighted average overall beta. Weighted average overall beta will be the overall beta of these two companies multiply by the weights. 0.84 into 0.7 plus 0.51 into 0.3. Yes, reply please. Reply please, everybody. This is a new type of question. Please reply. Please reply. 0.741. 0.741. This is overall beta of the industry on an average. Using it, we can find now the beta of equity of this business which X Limited is going to start. So step number 3, calculation of equity beta of X Limited. Calculation of equity beta of X Limited. Under that, write the formula. Beta unlevered into 1 plus d by e into 1 minus t. D by e into 1 minus t. D by e into 1 minus t. What is the debt equity ratio of this business? Debt equity ratio of this business is how much? 3:1. So you will write unlevered beta 0.741. This is from step 2. 1 plus debt equity ratio 3 is given. This is given, debt equity ratio, and 0.3 is the tax rate. 0.3 is the tax rate. Solve. Please solve. Solve and give me the answer. Answer please. 2.30. Is the answer 2.30? Yes or no? Only reply yes or no. 2.30, is it right? Okay. Now we can compute cost of equity as per CAPM. Cost of equity as per CAPM. Cost of equity as per CAPM. Formula RF plus beta of equity into RM minus RF. So you can round off in two digits. You have got 2.294. Make it 2.30. It's okay. 2.294 is also okay. Now answer please. What is cost of equity? Come on. Cost of equity is 24.1% approximately. Is it 24.1% approximately? Yes, very good. Next point, cost of debt. Next point, cost of debt. As per CAPM, no, cost of debt is normal formula. I into 1 minus T. Interest net of tax. Interest net of tax. Interest rate 16%. Interest rate taken from ICICI Bank at 16%. Tax rate to this company is 30%. So what is the answer? Please check. Is it right? Is it right? 11.2%. Is it right? 11.2%. Now write down step number 6. Step number 6, weighted average cost of capital. Weighted average cost of capital. Very good. Weighted average cost of capital. What is the weight of debt and equity? Tell me, if it is 3:1 debt equity ratio, what will be weight of debt and weight of equity? Anybody answer? 3:1 means how much weight assigned to debt? Total is 4. So weight of debt will be 3/4. Weight of equity will be 1/4. So write down. Formula for weighted average cost of capital is KD into WD plus K into WE. The debt equity ratio of this project is 3:1. 3/4 into 11.2. Very good. Plus 1/4 into 24.1. 1/4 into 24.1. Please solve. Please solve. Answer. Answer please. So are you getting 14.425%? 14.425%. 14.425%. This will be used as a discount rate for evaluation of new project. Write down step 7. Step 7, calculation of NPV. Calculation of NPV. NPV. Very good, Divya. Calculation of NPV. Year cash flow, PV factor or directly PV. No need to write factor. At 14.425%. At 14.425%. Year 0. 1, 2, 3, 4 given in the question. Year 0, 170 is given. Year 1, 50, 260, 340, 460. All these are given. Compute the present value. How do you do directly? You will type 50 divided by 1.14425. Press equal to. memory plus equal to memory plus. Then here 60 divided by 1.14425 press equal to 2 times memory plus, you will get 45.83. Do the same way, 40 divided by 1.14425 press equal to 3 times 26.7. Last one, try yourself. Last one, try yourself. Can you please try and give me the answer of last column total? Anybody please reply NPV. I'll wait for you. All of you must reply NPV. NPV. NPV is equal to 18.77. 18.77 is right. Negative. Very good answer. Very good answer. You got it right. Write the note. Project is not viable because NPV is negative. Because NPV is negative. Project is not viable because NPV is negative. That was a very good question from reference material. Source of this question, write reference book. But institute will pick this question and give you in the exam. One more question today. 27 number. Question number 27. Are you ready? Question 27. One more question where we have a combination of capital budgeting and portfolio. Very, very good question. Very, very important question. It can be a part of portfolio management chapter or it can be a part of advanced capital budgeting chapter. So let us start. Excellent Limited is a frozen food packaging company and is looking to diversify its activities in electronics business now. Now they want to enter into electronic business. The project it is considering has a return of 18% and Excellent Limited is trying to decide whether the project should be accepted or not. To help it decide, it is going to use CAPM. The company has to find a proxy beta of similar firm. Proxy beta means beta of similar firm for the project and has the following information on 3 companies in the electronics business. So this time what they have done, this time instead of 1 company, they have found 3 proxy companies. Their names are Superior Limited. Superior Limited equity beta is given. Debt equity ratio 50% debt, 50% equity, 1:1. Admirable, this is important. Admirable Limited has an equity beta of 1.3, but it has just taken on a totally unrelated project, accounting for 20% of the company's value, that has an asset beta of 1.4. But this company Admirable Limited is not just electronic business. Admirable Business Limited is into 2 business. One is electronic business and one is other business. The other business weight is 20%. So electronic business will have a weight of 80%. Is it right? I need to find the overall beta of electronic business only. I need to find out overall beta of electronic business only. So whatever overall beta I will get from admirable, from that we will identify how much is beta of electronic business only. The company is financed by 40% debt and 60% equity. So their debt equity ratio is 40:60. And other business has an asset beta of 1.4. Asset beta is overall beta. Asset beta is equal to overall beta. There is a third company, Meritorious Limited. Its equity beta is 1.05, financed by debt and equity 35% and 65%. Financed by debt and equity 35% and 65%. So what I have to do, basically question is to find proxy beta, and using proxy beta we can find out the cost of equity or the cost of capital which will be required for discounting of the cash flow. But in this question we are not required to discount the cash flow. Our duty is only to find proxy beta. Our task is only to find proxy beta, and for that I will have to use these three companies. In Admirable Limited, I have to further identify the beta of electronic business. At present, Admirable Limited is made up of two businesses. Okay, so let us first find overall beta. I will use the same formula which I have used in question number 26. Right. Step 1. Write down step 1. Calculation of overall beta. Calculation of overall beta. Company calculation overall beta. Company calculation and overall beta. Company write down superior. Company write superior. Look at the overall beta. Look at the equity beta of superior. It is 1.33. I am not writing the formula. Formula you can copy from question 26. And debt equity ratio is 50-50. 1 plus 1. Tax rate is not there. Enjoy. Tax is not there. What a life it could be if there is no taxation. The world will become altogether a very peaceful place if there is no taxation. Just try that option sometime. So my overall beta of Superior Limited is 0.665. Superior Limited is 0.665. Now try yourself Admirable. Try yourself Admirable. Admirable Limited. Its overall beta for the company's, its equity beta of the company is 1.30 upon 1 plus debt equity ratio 40% debt, 60% equity, 40 by 60. 1 plus in bracket 40 by 60. Come on, reply. Admirable overall beta, please reply. Overall beta, come on. Overall beta, after solving it, you will get 0.78. Check the answer. Is 0.78 right? Is 0.78 right? Okay, next. Meritorious. Meritorious. 0.78 is right. Very good. Meritorious 1.05 divided by 1 plus in bracket 35 debt, 65 equity. Debt equity ratio 35 by 65. Yes, Raju Sharma. 0.78 is right. You are AIR 10. Very good. I am AIR 2. Foundation AIR 4. Inter AIR 24. Final. So we have common pinch. Same pinch. Tick, tick, tick. Okay. Answer please. Answer please. What is meritorious? Overall beta 0.6825. Please check. 0.6825. Very good, Anup. 0.6825. Answer is not over. There is a small adjustment pending. This 0.78 is the weighted average of two business. 0.78 is the weighted average of two business. Electronic business and other, and their weightage is 0.8, 0.2, and the overall beta of other business is also given, which is 1.4. So you have to find what is the overall beta of electronics business. 0.8 into x plus 0.2 into 1.4, that is equal to 0.78. Very good, Sharma. Write down now. Note, in case of admirable, weight of electronics business is equal to 80%. Weight of other business is 20%. Weight of other business 20%. Therefore, 0.78 is equal to 0.8 into beta of equity, beta of electronics. This E stands for electronics business. You can mention, and 0.20 into overall beta of other business 1.4. Please solve the equation. You have to find this value is the missing figure. Then we will take average of the overall beta of three companies. Anybody who got the answer? Beta of electronic business. Beta of electronic business. Come on. Reply. Fast. Subscribe to the YouTube channel also, so that you will be updated. All of you subscribe to the YouTube channel also. So I got the answer from PV Divya 0.625. Very good. Amazing. Some of you are really dedicated student. 0.625. Hence average beta for electronics business. Hence average beta for electronics business. Hence average beta for electronics business. This is for superior. This is for admirable electronic business. This is meritorious electronic business. So overall beta, you can write in bracket overall beta. Is equal to 0.657. Is equal to 0.657. Is right 0.657. Is right 0.657. In bracket proxy beta. Proxy beta. This is what they will use. Excellent Limited will use 0.657 overall beta, 0.657 overall beta of electronics business, 0.657 overall beta of electronic business, and find equity beta by applying debt equity ratio used in electronics business, okay. By applying debt equity ratio in electronics business. I have given you few questions for homework. Question number 25, question number 23. I would sincerely request you to solve those questions for practice purpose today itself. Okay, just follow the instruction which I am giving you for this chapter. Everything will get covered in the class itself, and you will get confidence that you can attempt this chapter in the exam. As we'll go ahead, the chapter may become little more difficult, but if your conceptual clarity is there, you will be able to solve it. Okay, today we'll stop here. We will continue tomorrow at the same time. Okay, thank you very much. Bye.